Hey, good morning, it's Owen Bigland. This is the Inside Edge video blog. Time for one of my quarterly video blogs here on mortgages and how critical it is to go with the right lender and read the fine print on the mortgage you're signing. Any good mortgage rep or mortgage broker should be able to explain all the fine details of it and ask questions. So a couple of things I wanted to address in this blog here. In this ultra hot seller's market, more and more sellers now, they bought the condo or bought the house 5, 6, 7 years ago. They're up $300,000 or $400,000 on it. So naturally they're thinking, honey, maybe we should sell the house and cash in, invest the money elsewhere or downsize or whatever. It's vitally important that you check to see, first off, how much longer the term is on your current mortgage. Because a lot of people don't realize how heavy those penalties can be to get out of a mortgage early. If you still got 3 years left on the term, in other words, you renewed it for another 5-year term, and 2 years into it you want to sell, so you're canceling it 3 years early. You could be looking, depending on the size of the mortgage, you could be looking at up to $10,000 or more in penalties to get out of that mortgage. Now, every lender is different, and this is why you want to read the fine print. You know, I've always recommended in my blog here over the years that I prefer my lenders of choice are Royal Bank and TD. That's who I deal with, and that's who I recommend my clients to if they're looking for an institution to put their mortgage through. I think they're the best. I've got senior mortgage reps at both those banks. I have all my properties mortgaged through those two banks. They will match anyone's rate, and the fine print on their mortgages tend to be pretty straightforward. Unlike some of the second and third tier lenders that you can deal with, that if you do break a mortgage 2 or 3 years early, you can be in for some very, very severe penalties. Because a lot of them will use what's called an interest rate differential. And especially when you've got an interest rate environment that's been going down. You lock that rate in 3 years ago at, let's say, 3%. The going rate now is at 2.2. So you've got 80 basis point differential there. So if you're breaking that mortgage early, they will take that interest rate differential. They've got some crazy calculations. I can't figure them out. They're all different with every institution. But again, you can be paying thousands and thousands of dollars if you wanted to sell that house and break that mortgage early. So be careful, read that, and it's one of the reasons why, if you've got good credit, go with, I prefer TD or Royal or one of the major banks. Once you start getting into these second and third tier lenders, that's where the fine print can get pretty spooky. Now, in some cases, people have to go with these third tier lenders because their credit history might not be the greatest, and the big banks won't look at them. But if I see people all the time, though, that are using third tier lenders, and they're perfectly creditworthy. So keep that in mind. The other thing I wanted to mention as well is with this low rate interest environment, I've always told people that if a bank says that you can qualify for a $500,000 mortgage, it doesn't mean you need to take out a $500,000 mortgage. How about $450,000? Leave yourself a little bit of a buffer because interest rates have got nowhere to go but up. I don't want to sound like a broken record. I've been talking about this for years. But I think that there are a lot of people that are pushing themselves right to the limit here as far as what they can qualify for. I mean, you know, you take on a mortgage, lock it in for 4 years, you're going to be okay at 2.6% for the next 4 years. But I bet dollars to donuts that in 4 years, when it comes time to renew that, you're not going to be getting it at 2.4 or 2.5%. You might be looking at close to 3 or 3.2. And on a $500,000 mortgage, that could be another $200, $250 a month, every month. And some people, I think, if they're having a hard time just barely making the mortgage payments in this low rate environment, what's going to happen 4 or 5 years from now if that mortgage payment bumps another $200 or $300 a month? So leave yourself a bit of room there for increased mortgage rates. It's going to happen. I don't know when, but they're not going to go any lower from here. The other thing I would recommend is once you get into your new place, there's always a lot of expenses. You're buying furniture and getting settled. But take advantage of these low interest rates. I mean, I just locked in a mortgage on one of my rental properties, a 3-year at 2.19%. Now, you know, at those low rates, you know, it makes a lot of sense to try and chip off as much of that principal while the getting's good, Read your mortgage statement. They will allow you, most mortgages will allow you to put your mortgages on a bi-weekly or accelerated mortgage plan. So instead of paying monthly, you pay either every 2 weeks or every week. And that can shave thousands of dollars off your mortgage and turn a 25-year amortization down to like 21 years. So take advantage of that. Also, most banks, most major banks will allow you to put down a lump sum at the end of every year that goes straight off the principal. Read your contract, but sometimes it's anywhere from 10 to 15% at the end of every calendar year you can put down, and it comes straight off the principal. So take advantage of these low rates while the getting's good. We don't know how much longer they're going to last, and leave yourself a buffer if you can. I'm Owen Bigland. As always, thanks for watching. I'll see you next time.